welcome. You're watching the Small and Mid Cap Show. Well, one stock that is in focus is Anand Rathi. Well, they came out with the Q4 earnings update, and we have with us Mr. Feroze Azeez, Deputy CEO of Anand Rathi Wealth Limited, who joins us now to give us a brief about how the Q4 has gone by, how FY24 has panned out to be, and what does the future outlook for Anand Rathi look like. Welcome to the show, sir.
Good morning, Mahima. Thank you so much. Nice to be on your show. Yeah, I can give you whatever updates you need, so I'll stop you.
Sure. Good morning. So my first question to you is that, how has the Q4 gone by, one thing, and how has, the entire FY24 played out for you? Was it in line with expectations? Has it exceeded your expectations?
See, Mahima, firstly, from a quarter-on-quarter perspective, we don't look at the business as professionals as quarter-on-quarter basis because we are not selling a product, right? I'm not selling cars or phones. We are managing people's money. That's hard-earned monies of 20, 30 years. It's not quarterly we look at. It's a year's expectation we have. And that's panned out reasonably well, point one. Point two, we always have this tendency, be it a client or a shareholder, undercommit and over-deliver. Try our best. If God's grace is there, then you over-deliver. That's our principle. That's our DNA. If it's clients' commitments on their returns, we keep their expectations tampered down. So do we keep our shareholders tampered down. So, of course, it's better than the guidance we had given. We had initially, when the year began, we had guided 205 crores of PAT. And we revised that guidance in December to 220 and then finally closed at 226 odd. So PAT was over-exceeded in spite of an upward revision. Second, we had actually committed only 47,000 crores from 39,000 crores of AUM. We overshot that with God's grace and client support to almost about 59,000 crores. So I think, yes, to answer your pointed question, it exceeded the guidances for sure and marginally the expectations as well.
Right, absolutely. And so my next question to you is that in terms of AUM, the AUM mix, what I've seen is that in terms of equity mutual funds as compared to March 23, it has gone to 51% from 48%. And in terms of debt, it is reduced from 12% to 9%. So going forward, what do you think the AUM mix will be? What are the kind of trends you're observing here?
Yes, Mahima. Yes, 51% of mutual fund AUM. See, Anand Rathi's way of calculating or showcasing assets under management is, I would consider, a very, very clean way so that the shareholder can understand our business from an uncomplicated standpoint. So 51% in equity mutual fund, only distribution assets, no direct code advisory. That's 51%. So I think 50-55% is what equity mutual funds would be in the long run because that's what we recommend to our clients. So when we recommend to our clients, we make sure we try our best. We don't make sure we try our best to make sure that the clients have a portfolio in line with what mathematics says and what finance says. If I'm on a model portfolio saying 55, 35, and 10 on debt structure products and equity mutual funds, the clients should come somewhere thereabouts. And that's what we feel very happy about, that the assets we manage have very close proximity to what we recommend on paper. So that's one. 50-55% is what equity mutual fund would be at. In the long run, 30-35% in structure products, 10% in debt. Because we personally believe that debt is overrated for long-term investments. Indian households have 790 lakh crores of household savings, out of which half of it is financial savings, and 70-80% or even 85% of that is debt. Only equity is 6-7%, 8% on the overall household savings. Debt is overrated for long-term monies. Right. If you have 10-year money, so that's the mix which you currently see is what the long-term guidance will be.
Okay, that's very interesting to know. That was from a perspective of AUM in terms of product mix. I also want to understand that, what is your mix in terms of, your MF distribution, your sale of financial products in terms of brokerages and IT services. What is the mix there look like?
See, our business is very simple, both for a client or a shareholder. We do equity mutual fund structured products and debt mutual funds. This is the three products we currently do. Because mathematically, 11 years back, we realized that you don't have to do 20 different product lines. So to answer your pointed question, we had committed or not committed, we had guided that someday we will reach 50% trail revenue and 50% upfront revenue. We are trying our best to get there. If you see the revenue increase on the trail side is significantly more than the overall revenue. If you look at quarter on quarter, same quarter last year, there is a trail revenue growth of upwards of 60%, but the overall revenue growth is about 30-35% higher. So that implies that we're heading towards the 50-50, which we have indicated to the shareholder that we'll try our best. So to answer your pointed question, 50% comes from trail, 50% comes from upfront revenue, and some portion of brokerage, which is a very small, minuscule portion. Then coming to technology businesses, those are two subsidiaries which we currently don't value as very high value because we are in the trial and error business. They are bootstrapped, they make profits, but that's a technology business which we don't want to attribute any profitability in our projections at this stage because you don't want to overcome it because technology businesses are very dynamic and you're trying to still get your formula right, and that we believe has a 5-7 year gestation period. But it would be heartened to know that both these technology businesses, which are subsidiaries of the ARWL listed entity, are profitable and growing as well.
Understood. That absolutely makes sense. Now, just to understand in terms of your proportion between your existing versus new clients, what does it look like? First thing, and where is the the revenue, like in terms of margins, where is it flowing from? Like where do you see the growth prospect?
See, one is we see it very differently. When you look at it from our lens as professionals,
right.
We look at existing new clients where we are building trust. See, trust is a business which takes its own time to build. If you don't do lip service and you deliver what you're saying, you don't overcommit and underdeliver, over a long period of time, clients start giving you more and more wallet share because you're not selling products and running away. Like quite a few financial services firms would look at one's liquidity and give you a product and then disappear or at least not appear so frequently as much as an Anand Rathi Wealth Limited would. So point I'm trying to make is we see new clients and existing clients as not as revenue buckets. Those are relationships which you start, new clients, and that has gotten added 21% growth there. We've almost come to the 5-digit mark in terms of the total number of clients. So we've added a healthy new families, HNI families. There we don't look at revenue as their current year or next year or next to next year also. We try to build our relationship. We let them start small with us, test waters, and then we scale up. We don't force people to start big. We start them small, and our credibility tries to penetrate. That's why you would see 5-year plus clients give us significantly larger wallet share and also revenue. 3-year plus clients also do so. So new clients are not revenue machines for us. We see them as relationships which we like to build over long periods of time.
Understood. And just trying to understand, since you mentioned HNIs and you try to build relationships with them, what kind of client additions happened in FY24? One thing, what are the trends and what kind of client additions are you expecting in HNIs in FY25? Because that's your point of focus, I believe.
Yes. See, when you have satisfied set of 8,400 families, and if they also have friends, every HNI in their phone book has 10 more HNIs. So if I keep doing good for them, they also want good for their friends. So they proactively refer. So to answer your pointed question, our aspiration, not a guidance at all. It's our dream to have one new client per relationship manager per month, which is about 330 odd. That's our aspiration. Of course, we've not met that aspiration for long periods of time, but that's what I think this business has the potential of. Every RM has a capacity of having 50 clients per head. We are at 30 currently. That implies that you have 20 into 330 new clients you can add without new RMs. That 6,600 new clients can be added with the existing capacity which an RM has to deliver the Anand Rathi proposition without having to dilute the service level. levels.
Right, very interesting, very interesting. And so my question now is from a macro perspective, with the kind of regulations that are going on, around all these mid caps and small cap mutual funds, there's stress test taking place. Do you see that, because the AMFI data for the past month also suggests that, the mutual fund flow in mid caps and small caps did go down. So what is the kind of trend you're observing going forward? What do you think? Will this impact the mutual funds for small and mid cap, or no, it won't in the long run?
I think it won't. Because India has got a lot of money. And if you're going to propagate financial service, financialization, you have 800 lakh crores of household savings, and you have 2.5 lakh crores in small cap funds. Look at the proportion. It's a fun decimal number. Out of 800 lakh crores, you have 2.5 lakh crores in small cap funds. So if there is going to be financialization, there is going to be money which will flow. Unless there are good quality businesses with huge free floats in the capital markets of India, we might be the world's largest number of listed stocks. But I think the depth in terms of free float is limited. If you look at the 300 stock in the chronological order, arranged in the descending order of free float, it would be 7,000, 8,000 crores or 9,000 crores of free float. And we are speaking about a country which has more than 100 crore people and 800 lakh crores of financial assets, total assets. So I personally think small caps might have some small jolts, but if India starts to invest and financialize their old household savings, then there is going to be a supply constraint of stocks and businesses than a demand constraint of money. Is what I think the macro clearly indicates.
Right. So that means that the kind of trend that is playing out in SIPs right now, we don't see any kind of down cycle in the near term or in the long term, right?
I don't see it because there is a huge hypothesis, so I say the answer is no. And what is the hypothesis which needs to be tested to have some degree of confidence levels to make the statement is the fact that if you look at last 2 years, Nifty has done whatever it has to do. It has 2 years back in October 2021 or 2.5 years back, it was at 18,000. It went down to 15,900, went back to 18,000, went back to 15,200, went back to 20,000, went back to 18,000. All this has happened, but the SIP number has remained steadfast. And it has been coming. It implies that earlier people used to come on the basis of past performance. This time around, after 10 years of education of investors, which SEBI initiated on 1st January 2013, people are coming out of discipline rather than greed. If this hypothesis is true, in my opinion, if I've tested it, it's true with the significance levels which are commendable, I would say this number is going to be far more solid than people may want to believe.
Right. That makes absolute sense. Well, Mr. Azeez, thank you so much for taking out time in speaking with us at NDTV Profit. I hope all your aspirations turn into reality. Thank you so much for speaking with us.
Thank you, Mahima.